You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, let me center myself. Hey guys, what's up everybody? It's Jonathan and welcome to Masters in Trading Live. At Masters in Trading Live, we go over the market every single day. The market's open, 11 o'clock Eastern Time. Share some of our thoughts. Announcement, July 4th weekend. July 4th weekend today, Wednesday, half day. Tomorrow, school's closed. July 4th weekend. I think it's a half day on Friday. We're closed. On Friday, we're not going to have Masters of Trading Live. There is NFP, non-farm payroll, on the morning of Friday. Be careful, but we are not going to have a Masters in Trading Live announcement. If you have not yet gone to mastersinTrading.com/earnings, watch the presentation on Earnings Advantage today, 1 o'clock Eastern. We're going to have our kickoff call for the Earnings Advantage program. Super excited for this. Today we got 4 topics. It's really one topic. Today we're going to be talking about bonds. The topics: 1 to 3 year, 3 to 7, 7 to 10, 10 to 20 plus. We're going to be talking about the yield curve. The Federal Reserve is raising interest rates. But when they raise interest rates, they're not raising the 20-year or the 30-year. They are raising very short-term lending rates. So that has a direct effect on what's called the yield curve. The yield curve are the yields from notes all the way out to bonds. So we have very, very short term, 1 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30 year. The further out you go, the higher interest rate you should get. But when times get a little wacky, that short-term interest rates spike, and what ends up happening is we have a flat yield curve. So let me go into the slides, because many people are trading bonds, but I want to show you that it's a sophisticated trade. These trades are something you have to learn before you go in and risk a whole bunch of money. So let me show you. I'm going to be using futures, but I'm also going to be using ETFs, because the futures can be replicated using ETFs. Let me go to the screen. I'll show you exactly what I'm talking about. Here's a little overview. What bonds can we trade? What are the liquid instruments that we can trade? Short-term treasuries, we have the SHI and the SHIV. Intermediate, IEI, IEF. And then long-term treasuries, you could trade the TLH or the TLT. Many are familiar with the TLT because it's got the most amount of liquidity for ETFs. Well, these bonds are also traded in the futures market. In the futures market, these are the symbols: 2-year, 5-year, 7-year, 10-year, 18-year, 30-year. Okay? TLT is directly correlated with the ZB. The ZB is called the 30-year bond, but when you look under the hood, it's filled with 18-year bonds. So if somebody wants to trade TLT, you could also trade ZB. They are directly correlated. Here's how traders should be looking at the bond market. And I'm going to go through an example. Here are all the futures. And I'm going to keep this up throughout the presentation just so it doesn't get even more confusing than this might be. This is a bit of a sophisticated trade, but I just want to show you that there's more to just trading bonds than just trading bonds. So what are we looking at here? Well, the green is going to be the 10-year. Okay, so this is going to be the 10-year. The blue is going to be the 18-year. So the blue is 18 years of duration. The green is only 7 years of duration. They're correlated, right? A 7-year US bond and an 18-year bond are correlated. But once in a while, those correlations break down. When those correlations break down, traders can do a trade betting on them coming back together. Hopefully you guys have seen me do a divergence chart with, say, gold and silver. Well, here I'm doing it with a 7-year bond and a 13-year bond and an 18-year bond. So this is 18 years. This is 7 years. All I've done here is one product, 18 minus 7, ZB minus ZN. And so once in a while, you'll notice ZB is stronger than ZN, but down here, it's flip-flopped, right? Where the blue is now weaker. You can see that here as it rallies up here. These charts are the same. This is two products. Down here is just one product, one minus the other, so we have one spread. But these two charts are the exact same thing. We can do the same thing on the next chart. On the next chart, I'm showing you ZN, which is a 10-year future contract, which is actually 7 years of duration. So I'll call this 7 so I don't confuse anybody. And then the 5-year is right here. We're looking at the difference between 5 years and 7 years. They're correlated, right? They're moving together. They pretty much look like the same product. But what we can also do is do one minus the other. SF minus ZN. This is just a divergence. This is just a correlation. Moving together. Here, they break apart. That just means the difference between these two is getting further and further together until they end up coming back together. It's a really cool trade, but this is why whenever we trade correlated products, we always want to use divergences. We don't want to look at just one product. Hang with me, guys. This is all going to end up coming to a grand finale, and we might even get a trade at the end. So stay around with me. What about if we get even a little bit more advanced? Because what are we doing here? ZN against ZB. Okay, that's going to be these two. ZN, ZB, right here. The green is going to be ZB against UB. Okay, so this is going to be the green. The blue we know as ZN versus ZB, these two. And then the white is going to be ZN all the way out to 30-year. And so look at this. So for instance, this thing right here is ZN against ZB. So if a trader wanted to take advantage of this right here, they would sell 10-year. They would buy ZB. Down here, they would buy ZB. And they would sell UB. So if a trader wanted to take advantage of this right here, this is the trade that they would end up doing. If I wrote it out like this, that ZB, call that 18 years. And you're selling 18-year. And you're buying 7. And you're buying 30. And that's called a butterfly. Now again, why am I showing you this? Yeah, it's a little bit advanced, guys, but I want to show you that we need to learn what's going on. When you just trade in the market and you think that bonds are going higher, bonds are going lower, and you sit in there and you jump in and do a trade, what I want you to see is that there's so much more to learn, okay? There's so much more to learn. Be patient. What do I have here? Here, I'm actually simplifying everything for us because this is the ZN. This is the ZB. Now, those are confusing, right? How about this? This is 7-year notes. This is 18-year bonds. Does that make it easier to understand? Right here, you buy TLT on a bet for TLT to go higher. Right here again. Right here, bonds, which we can express using TLT, are very inexpensive relative to this part of the yield curve. So traders have the option, that's punny, to make a bet on TLT going higher. Let's dig a little bit deeper. You guys have seen me use this. If you watch mastersthandtrading.com/live, you'll see me use these expected move. This is just how the options are priced. TLT historically stays within its expected move 72% of the time. Right now, TLT is at the bottom of its expected move, just like it was in June. That looks like a pretty good buying opportunity in TLT. Remember, we have a buying opportunity using the expected move, but if we go back to these previous charts, just like here, where ZB got inexpensive, where TLT got inexpensive relative to the 7-year, the belly of the curve, we're seeing that behavior right now. So TLT is inexpensive to 10-year. That's one reason to get long TLT. TLT is at the bottom of its expected move. That's 2 reasons to get long TLT. Here's another one. TLT, these are just 3 and 4 standard deviation bands. When we trade outside of the bands and then back inside, we'll get a trade signal. When we trade outside and get back inside, we'll get a trade signal. Same thing here. We're not getting a trade signal yet, but it sure looks like we're pretty darn close. Let me leave you with one more chart. These are bonds going back to May. What we're looking at is implied vol. We're looking at volatility. These are volatility bands. Lately, what's been happening is bonds have been rallying up to their bands and selling off. In June, bonds have been rallying up to their bands and selling off. Well, now we open a little bit lower, not attacking the top of the bands. If anything, looking at the bottom of the bands, this might be a pretty good place to get long TLT. Now, let me get back in the middle. I wanted to go over that example. A lot of it to show that we're not just looking for head and shoulders. We're not just looking for double bottoms when we're analyzing bonds. When we look at silver, silver is making a big move today. When we look at silver, we look at divergences across the metals. We want to be long what's inexpensive and short what's expensive. So with the bonds, hopefully you can see through that presentation. If that didn't make sense, please go back and watch it again. Right now, that TLT is very, very inexpensive relative to the rest of the curve. Now, should you get long TLT? You absolutely could. Now, for me, no trading until we come back from the July 4th weekend. So if we can still get these levels or better coming on Monday, I'm going to get on here during Masters in Trading Live and say, hey, TLT, let's get right back in. But for right now, going into the July 4th weekend, I'll take a pass. I'd rather watch it. I don't mind missing a few trades in order to have that dry powder coming up Monday. For everybody else on our All Access, hang on. We'll get right back in a bit.